Well, greetings and salutations, test takers. This is the Series 7 Guru coming to you from my studio in fabulous Las Vegas with another explication request. This is a question sent in where a customer sells two BFD 40 puts at 10, sells two BFD 40 calls at 5. Well, the first thing you need to be able to do as a test taker is identify the strategy. And we should know that when we sell a put and sell a call, that this is a straddle. So test question number one is, can you identify the straddle? Because if you don't know this is a straddle, you're just going to be staring at the screen. The second test question, once you've identified a straddle, this is a short straddle, is to calculate the break-evens. This is the only one where you have two break-evens. You have an upside break-even and you have a downside break-even. The way you're going to do that is total the premiums. So here I'm selling volatility. It's not my friend, but I can take a hit 15 points up, 15 points down. My upside break even is 55. My downside break even is 25. Third test question is, where do I want it? We have a nice memory aid device for profitability and straddles, silo, short inside, long outside. If it's a short straddle, I want the market price of the stock, in this case PFD, to be somewhere between 25 and 55. If the market price of the stock is between my break evens, I make money, right? So that's going to be important. And the third test, our fourth test question is, when do you use a straddle? You use a straddle, a short straddle, when you expect it to stay within the trading range here, 25 and 55. You buy a straddle when you expect volatility. I'll link to a lecture I have on straddles, but I call it score four more. Those are the four test questions. Can you identify the straddle? Can you calculate the break evens? Can you determine where it's profitable? When do you use it? Okay, so let's look at this question. At expiration, BFD is trading at 28. So one way you could do is just memorize break evens. You could just say, okay, well, my break even is 25. 28 is 3 points in my break evens. I got a 3-point profit, two contracts. Profit is $600. That's one way to proceed. The puts are exercised. I shouldn't have to tell you that at expiration, if BFD is 28, that you're going to get exercised on the 40 puts. I mean, you should know that if at expiration, an option contract has intrinsic value, the contract will be exercised. So I shouldn't have to tell you that. You should know that at expiration, if you're short a 40 put and the stock's at 28, somebody's sticking it to you. And I shouldn't have to tell you the calls expire. You should know that 40 calls at expiration of the stock is 28 are going to expire worthless. Here it's given information, but it is something you should know. Now, if you don't want to memorize break evens, and it's up to you. I mean, memorizing break evens is the way to go. I think if you understand contract specifications, you're not struggling. This is an obligation to buy the stock at 40 and an obligation to sell the stock at 40. You can track money. I think that's a better way to proceed, but it's buffet. Take what you like, leave what you don't. I call this the initial setup. So here we are selling the 40 puts and 40 calls. We got 10 points. I suggest you do this on a point per share basis. Otherwise, it's going to be a mess. What I mean by that is that would be, 2,000 and the next one would be 1,000. I just think you should do per share. But again, buffet. Take what you like, leave what you don't. So then we brought in 5 points there. I'm doing it on a per share basis. By the way, break evens are expressed on a per share basis. Okay, the puts are exercised. That means I'm buying the stock at 40. The calls expire. And the stock is 28, right? So boom. So now I just net those and I say, okay, well, I'm out of pocket 40. I brought in 43, so I made 3 points on two contracts, each of those contracts covering 100 shares. So the answer to this question is that we have a $600 profit. Again, I would like you to fire up that T anytime you can, track the money in and out. But again, 4 test questions on a straddle. Can you identify the straddle? The straddle is when you're long 2 different type of contracts or short 2 different type of contracts. Can you calculate the break evens? It's the only strategy on Series 7 where there's 2 break evens. And the way you do that is total premiums, 15, strike price plus total premium, upside break even 55, downside break even 25. Where is it profitable? We have a memory aid device for that. Silo, short inside, long outside. If it's short, we want the market price to be in between 55 and 25. Here's 28. That's a winner. I'm a winner. And then when do you use it? Here you expect a trading range. I would point out here that this does have unlimited risk because of that naked call. All right. Well, hope you found that helpful. Send your request to Dean, the Series 7 Guru at gmail.com. And remember, inch by inch, your Series 7 is a cinch. Yard by yard, your Series 7 is hard. And again, in the video description, I'll link to a lecture on straddles, and I'll also link to it in a pinned comment. Bye-bye.